Welcome to Money Listens J, the place where we pull back the curtain on the financial systems designed to keep you in debt. Last month, I logged into my account to pay a bill, and there it was. A friendly pop-up. It asked me to update my income to help us serve you better. Most people see that box, enter a number, and click Submit. Without a second thought, they think it's a requirement, like giving a phone number. But here's the truth they don't want you to know. Banks are not required by law to have your updated income for a credit card. They ask because knowing your salary helps them make more money from you. The moment you hit Submit, you aren't getting better service. You are handing over data that triggers an algorithm. This algorithm instantly categorizes you into a profile that determines your future. It decides your interest rate, your credit limit, and exactly how many predatory offers will flood your inbox. They aren't looking to help you. They are looking for the lifetime value they can extract from your pockets. By refusing to volunteer this data, you introduce uncertainty into their models. And in the world of banking, uncertainty for them usually means better treatment for you. Now, let's talk about the two biggest tools the bank uses once they have your number, credit limits, and interest rates. On the surface, a higher credit limit feels like a reward for your success. The bank makes it seem like they trust you more because you earn more. But in reality, higher limits are often not in your best interest. They are designed to enable more spending and create more opportunities for you to accumulate debt. Banks know that people with higher limits tend to carry higher balances. They aren't giving you more room, they are giving you more rope. Because customers with more rope tend to hang themselves with interest payments. Even more disturbing is how they use your income to set your interest rate. You might assume that a higher income makes you a lower risk and therefore earns you a lower rate. However, banks often use ability to pay pricing. If the algorithm sees you earn $200,000, it predicts you are less likely to shop around for a better deal or notice a few percentage points difference in your statement. Studies have shown that affluent customers sometimes receive worse terms simply because the bank knows they can afford to pay more without leaving. Your high income becomes a signal to the bank that they can charge you more just because they can get away with it. They aren't pricing based on your risk. They are pricing based on your tolerance for being overcharged. The most persistent way banks use your income data against you is through highly targeted marketing and upselling. Once you reveal that number, you are instantly categorized. High earners don't just get better offers. They get aggressive pitches for premium cards with high annual fees and complex investment products they may not need. Every time you log in, you are navigating an obstacle course of upsells calibrated specifically to your income bracket. On the other side of the spectrum, lower-income customers are targeted with predatory offers, such as balance transfers with hidden fees or personal loans at steep interest rates. What many people fail to realize is that this data has a very long half-life. When you enter your income, it doesn't just disappear after your application is approved. It sits in your file for years, shared with affiliates and partners in ways you would never expect. That figure you provided 5 years ago might still be influencing whether the bank decides to increase your interest rate, decrease your limit, or even close your account during a period of economic uncertainty. Banks have long memories, and they use that historical data to preemptively minimize their risk or maximize their extraction of value from you, often regardless of your actual payment behavior. The final piece of the puzzle is breaking the psychological conditioning that makes us feel obligated to comply with every bank request. We often feel that non-compliance is risky, but in reality there are no consequences for ignoring an optional income update. Your accounts will function normally, and your credit score will remain unchanged. Refusing to volunteer extra information simply reduces the data asymmetry, putting you on more equal footing with the institution. Going forward, be strategic. Only provide income when it is federally mandated, such as during a mortgage application, or when it directly benefits you, like when you are intentionally seeking a higher credit limit. For existing accounts, when those pop-ups appear, simply close them. If a bank representative calls you to update your profile, remember that you have the right to decline. By practicing data minimization, you ensure that your relationship with your bank is based on your actual behavior, your payment history, and responsibility, rather than a number they can use to exploit you. Stay in control of your data, and you stay in control of your money.